When someone loses a spouse, there are a lot of changes that happen financially speaking, and one of the big ones is a change in tax situation. In today's episode of Friends Talk Financial Planning, we're going to share some of the specific things that people need to be aware of when they lose a spouse that pertain to their taxes that they might want to think about before the end of the year. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Mermel. I've got a fee-only financial planning practice in Chicago, Illinois. And please go ahead and hit subscribe. It helps people find us. We think we provide valuable information and help us grow. All right, John. We've got the unfortunate situation that someone's spouse died.
Yep.
And this could be someone who's dealing with their own spouse's death, or it could be like a friend or their kids that are dealing with, or that are trying to help somebody whose spouse died. So in both situations, I think this is good information. Sometimes a person whose spouse died goes through a period, and this can even last for a couple of years, of like just brain fogginess. And so I think offering to help and knowing a little bit about this is important.
Yep, that's exactly right. And it's really important. I think there's a lot of different financial things that go on, right? Changing titles on accounts, and there's just a lot of stuff here. So we wanted to focus specifically on a few of the tax things that change. And I love that idea, and as we were thinking about this episode, I've got a friend whose mom died earlier this year. And so I'm talking with my friend who's helping his dad figure out some things, right? It's that sort of situation where, all right, there's all these other things going on, but for me talking to my buddy and saying, hey, make sure you're talking with your dad about here are some things that might be coming down the pike for him, and let me know if I can help, navigate some of these things, because it can be a surprise. We don't realize oftentimes that difference of where the tax situation changes, right? We think about changing the IRA accounts and naming and all these things, and then taxes come in the spring and you go, holy mackerel, there was a big surprise. I didn't realize what was going on here. And this is one of the cases where because we kind of know there's going to be a change in situation, there's an opportunity at least to look at and say, hey, should we be doing something? Should we be a little proactive with this? And so that's where this is coming from. And I wanted also to point out that as we were thinking about this, that there are some things that apply if you have children at home. Maybe if it's a younger person, I tend to think about the older folks, because that's who I've been helping with, people with, and my buddy particularly right now. But we'll talk about that, some of those changes here. Let's make sure to bring that up when we get to that spot.
Okay, great. Right. So first thing we want to be mindful is your status. Okay, so people don't, we think about our status when we're trying to join a country club.
Right.
But we're not thinking about our status when we're filing our tax returns, but it's one of those underlying pinnings of the tax return. So you can be single, you can be married filing jointly, but there's a couple of lesser known statuses too. One is qualifying widower, and another is head of household.
Yep.
Okay.
Let's maybe just jump in on those big two, right? Most people, it's I'm married filing jointly or I'm a single person. And what are the differences in those? And that's what affects a lot of the people that we're talking about here. And one of the things is the tax brackets. Like the rates are the same, but what income falls into those rates is really different.
Right.
We can pull up a little chart here that shows, and I don't know why I picked $80,000 in my head as far as I was thinking about this, but look at taxable income. If we're at $80,000 here in the married filing jointly, you can take a look at that line right there. We're solidly in the 12% tax bracket, right? Making a nice income, we're paying our top brackets 12%. If that same income is in the single bracket, move over one column to the left here, that income is solidly in the 22% tax bracket, right? So that's what we're talking about with these brackets, and the same amount of income can be taxed at very different rates depending if you're single or married filing jointly in this case.
Right, in that particular bracket we picked, because that's 10%. That's a lot. So that's a pretty big shift.
Right.
Okay. So that's, and there, it can be very easy to go from that.
Right.
Hot brackets, which sounds like better status, but people don't like it.
Right. Well, and think about it. And again, I'm thinking about my buddy's, parent situation. I don't know all the details about it, but let's say their income was, taxable income of $80,000. Mom's gone. What changes in their situation? The pension that they were state employees, and it was, and the way they selected it, the pension stays the same. So that income that they've had the last, 5 or 7 years is going to be the same for dad going forward. So the income hasn't gone down. Social Security is going to change, right? We're going to lose some Social Security, but it doesn't go to zero. It's like a third to a half, right? So yeah, Social Security going to go down, but not, not away, right?
Right.
And then they're in a situation where they have to take minimum distributions from their IRAs. Dad had his, mom had his.
Hers.
Now it's all. Thank you.
You never know. You never know.
So, but it's all going to be his going forward. So basically the same distribution is going to happen. So their IRA distributions are going to be largely the same. Their pension income is going to be largely the same.
Yeah.
Social Security is going to go down something, but not a lot.
Yeah.
So if they were making $80,000 of taxable income last year, maybe this year going forward it'll be $70,000 or $60,000. Well, you look at those difference in tax brackets, and I don't think we've really mentioned here what happens is when somebody dies. So my buddy's dad, this year, if you're married during the year you lose a spouse, this year you get to file as married filing jointly. Right. Next year, he's going to be filing as a single taxpayer. So that's where this difference really comes in, is going from married filing joint to single. We know he's going to transition into that tax status going forward, and that's where some of the planning opportunities can come in.
Right. And one of the tricks that we're not going to cover here is if you do have kids that are living at home that are dependents, then you're in a different situation and you want to look up qualifying widower. Find out all about that.
Right, so that's the takeaway.
Yeah.
Check into that. Hey, if I've got kids at home, maybe I'm a younger person.
Right.
Check into that qualifying widower. Make sure that your tax folks don't miss that, because that is one of those kind of corners of the law.
People who are older have kids at home too.
Yeah, right, right.
You might be raising your grandkids or whatever. Yeah.
Exactly. So know that kids at home, the same general rules apply. The planning part applies, but the specifics don't necessarily apply here. Right.
Okay, so the next thing we want to talk about is the standard deduction. Okay, so with the tax bracket differences, this is a plus of being single, actually.
Yeah.
So when you look at what the standard deductions are, that if you have more than the standard deduction, you can itemize, which means that you can deduct your state and local tax, your mortgage interest, and charitable
gift
contributions.
to charity. Yep.
And maybe a few other things, but those are the three biggies right now. So it's a little complicated because the state and local tax is capped at $10,000. So that means a lot of people aren't itemizing anymore. But that cap is only is the same if you're single or if you're married filing jointly. So the single person, you're married filing jointly, and your state and local tax is $16,000. You can only take 10. And so then you have to come up with quite a bit of other expenses to be able to itemize.
Right.
In the same situation, your state and local tax goes from 16 to 14 because of losing the spouse. But because it's 14, you can still take 10. And then you only need a smaller amount to be able to itemize. So if you've got mortgage interest or you're donating much money, you'll be in the ballgame for itemizing, which you weren't before. So your tax brackets are going to hurt you, but you might be able to itemize, which is going to help you.
Right, and that's where it comes down to one of the takeaways is taking a look at it, right? When there's changes, if everything's the same every year, oftentimes there's not a lot of planning opportunities that come up. This is one where we go, tax brackets are going to change, right? If we're going to go from married filing joint to single. And we like to talk that, hey, we know what today's tax situation is. We think might happen depending on Congress and all of it, but we just don't know a lot of the future. This is one of the few places we know that there's going to be a change. There's going to be something we can maybe take action on. And then, the other thing is so many of us these days, our mortgage interest isn't deductible if you have one. Donations to charity, because when you're married filing joint, what is like $29,000 is the standard. So until you get over that, you don't get any benefit. Now it goes down, if I'm going to be a single taxpayer, it goes down to 14 or 15 next year. So one of the thoughts might be, hey, this year for my buddy's dad, while I'm going to be married filing joint, I'll just take the standard deduction. So maybe my charitable donations, right? Maybe we brought in money from mom's funeral sort of thing. It's going to go to charity. Maybe we want to wait until January to make that donation, because then it'll get credit for it, right? Some of these little nuances, but it can be $1,000 of savings just by paying attention to it.
Yeah, so you could push off things that you can deduct, but then actually realize more income.
Right.
So you might say, oh, the top of the 12% bracket taxable income when you're married filing jointly is around 95,000, 94,000.
Right.
Why don't I take more out of my IRA this
Right.
year? Why don't I do a Roth conversion this year? Maybe, and there's more too. It's like,
Right.
so depending on your situation, you might want to realize some income while you can still be in that lower bracket.
You just reminded me 4 years ago when my mom died, so my dad's in this situation, right? I kind of forgotten I'd gone through this, right? It was exactly what you just described. Hey, their income, pension, and Social Securities are this. We know that
Right.
dad's in that married filing jointly bracket here today, right? And geez, there's some room. Why don't we take, and I don't remember the numbers off the top of my head, but why don't we take an extra $15,000 or $20,000 and take that money out and pay 12% taxes? Because next year he's going to be paying 22% taxes on it, and do a
Right.
Roth conversion. And
Right.
like that's the exact sort of thing that 1 year we've got that, next year we're not going to have that. And I think one of the big takeaways is just that doing the planning, right? Just
Right.
taking a look. The tax software that Bridget and I use, we can plug in the information, make some of those adjustments. Oh, we know that Social Security is going to change a little bit, and then you click a button. What if we're married filing jointly
Right.
this year? Great. If we click that button next year, here's what that same tax
Right.
looks like, and go, okay, let's kind of play with that. And being proactive, I think, is one big takeaway.
Yeah, and so this is a year. You've talked about how, like, a lot of years people are like, why am I bothering with this
Yeah,
tax
right.
planning? It's the same every year. I'm just chugging along. Okay,
Right.
now is the time where tax planning really makes sense.
Yep.
Okay, so you're going to have 2 years where you're not just chugging along, you've got a lot going on. And it's unfortunate that you have a lot going on in your whole life, and your taxes might, I don't know why, they might not be the top thing on your mind.
Right, right.
But that's why we are encouraging the other people around you, if you know someone who's dealing with they losing their spouse, this is a great way you can help.
Yep,
By
yep.
saying, hey, you want me to help you with some tax planning?
Right, let's pay attention to this.
Yeah,
right?
let's think about this this year.
Absolutely. Hey, that's a great place to wrap things up here. Again, I'm John Shear. I run a fee-only financial planning practice in Middleton, Wisconsin.
I'm Bridget Sullivan Mermel. I've got a family financial planning practice in Chicago, Illinois. John and I are both taking clients, but we also belong to an organization that's the Alliance of Comprehensive Planners. You can find out more about them at acplanners.org. And if you're interested in an advisor in your area, that's a great place to look.
That's right. And don't forget, hit that subscribe button.